I'm going to do something where we have a small discussion first, where I'll do a presentation and it'll be followed by a panelist discussion. Since we have a lot of eminent panelists, what I'm going to do is the heavy part, which is the philosophy and the policy, I'll leave for them. And I'll take the easy part, which is the end result of the philosophy and policy, which is the asset allocation. And the end result of the investment process is, of course, the returns that come in the future. So we'll talk about this very crucial step here, but the heavyweight discussions will be after this. So the importance of asset allocation, as you can see, what we have shown here is something on the left side which is very oriented towards fixed income, and on the right side it is heavily invested in the equities. So we made a very simple example, and with 80-20 distribution either on fixed income and equities or the other way around, and there is a certain long run assumption behind it which applies for India, and this is the kind of return. So 8% if you are fixed income oriented, 12% if you are equity oriented. So very different returns over long term after compounding. So it plays a very important role, and this has been proven over and over through academic research. It has also been, of course, everyone has found out in their own portfolios. So we'll look at some of the largest and most sophisticated investors across the world and how they go about doing their asset allocations. So this is one of the largest sovereign funds with about $700 to $800 billion under management, and this is how their asset allocation looks. Okay, so this is how it looks, where equity is about 64%, fixed income 35%, and they've just started on real estate where they hope to take it to maximum 5%. Okay, regional allocation looks something like this, where US is about 30, Eurozone is 20, UK is 15, Japan 7, and rest includes emerging markets. You look at Abu Dhabi Investment Authority, which is another mega fund with more than $600 billion. And again, you will see something like 40 to 50% in equities at least, can go up to as high as 67% according to their strategic allocation. And again, you will see real estate is about 5 to 10%, alternatives 5 to 10. They've classified private equity separately from alternatives. They also have an infrastructure focused fund from 1% to 5%. Again, regional bias, you will again see North America always gets the highest allocation most of the time, which is primarily US. Europe gets about 30-35%, and developed Asia, which is again primarily Japan, which is about 15%, and emerging markets is about 20%. So if you look at it, and we have a study here which shows that the average allocation of all the large global pension funds is equities more than 50, bonds are about 30, alternatives about 20. Okay. Now this is a very interesting quote you can see from the Ontario Teachers Pension Plan, where normally we think equities is high risk and fixed income is low risk. Okay. But you look at this, what is he saying? They're saying equities have high risk in the short term, but low risk in the long term. And fixed income has low risk in the short term, but it is high risk in the long term. Okay? So it's probably everyone knows, but it's good to be reminded of it, good to think about this and allocate assets accordingly. Okay? So since equities are the most important growth portion of the asset allocation, the whole focus depends on what you're going to do with that, how you are going to go about doing it. And of course, the basic method historically accepted was you go and pick stocks and buy and create a portfolio. But there are a lot of problems with that, because A, the control investor always has more information than you. So there is asymmetry of information on the one side. So you're missing the most crucial information, that's not accessible. On the other side, you have information overload, where you're getting bombarded with all kinds of information which everyone else also has. Okay, so you're struggling against this if you want to win on buying stocks directly. So people go many times with active fund managers who are experts, who are professionals, who have teams and methodologies set up for this. Only problem is the record shows, and this is an 8-year-old record. The first time this was figured out, was published, was by Cowles Commission, 1932, that hardly any active funds are able to beat their indices, benchmark indices. So it's as old as that, and it's being repeated continuously again and again through various studies. S&P comes out with a study, SPIVA studies every year. Vanguard has been publishing these kind of information all the time. So there is a problem that even if you pick the funds or the good fund managers, it's still going to be difficult to outperform your benchmarks. And even the few who outperform are usually inconsistent. They can't maintain, it just happens for a period and then it's not repeated. And it's all attributed, a lot of it is attributed to behavioral issues. Behavioral finance has been studying that for a long time. The last one is you could directly buy the index itself. At least you are assured the benchmark returns, maybe a little bit of minor costs below that. Okay. The problem with this is typically the indices so far have been market cap weighted. So they are very good for saying what has happened in the market today, how much it has gone up by. So that's an exact calculation with a market cap weighted index. But as an investment strategy, even though they happen to beat most of the fund managers or buying stocks directly, it has a flaw, which is that it is likely to be overweight on overvalued stocks. So what is the end result of all this? The US, we'll just look at the US because it is ahead of the curve. Most of the time there, the trends which happen there follow up. Allocation there currently is 35% passive and 65% active. Okay, and this includes majority retail investors. So for institutional, family offices, pension funds, it's much larger. There are people, the Abu Dhabi Investment Authorities, for example, is at 55% index investing. Okay. So the very large proportion is in passive. And this is the last 2007 to 2013, you can see that $600 billion has moved out of active mutual funds, and all of that has gone into either index mutual funds or index ETFs, and $200 billion more. So there is, this trend is anyway getting well established. There is a history behind all this. As I said, 80 years back, 1932, someone came out with a first study of the funds. After that, about 50 years back, there's a lot of academic research which proved that it's difficult to beat the market. And last 20 years, this trend has started, and today, people like Vanguard and BlackRock run $1 trillion plus assets in passive. Okay. And there is one more trend within this passive trend, which is smart beta. Many of you might have heard about this, but it might be new to some, so we'll just go through it a little bit. Smart beta is a trend within somewhere between active and passive. So while 50 years back, around 1960s, last year's Nobel Prize winner Eugene Fama, had established that it's difficult to beat, that the market is efficient, everything is known, everything is priced in, because all the smart active fund managers are trying to beat. So you can't beat. That was accepted. He himself, with Kenneth French, came out in '93 with a paper where they admitted that actually it's possible to beat it a little bit, wee bit. And that's the foundation for smart beta. So they found two effects that time, low price to book, size effect. So they admitted that yes, there is a little bit extra return because of that, and then they tried to explain it away by probably it's a higher risk. Whatever the explanation, people who want to make money started making money on this, and all kinds of funds started being generated on this ideas, and now there are multiple factors, and where factor investing is done, all of those put together is put under smart beta. So what is smart beta? It is any passive index tracking strategy, but which is not market cap weighted. So even an equally weighted index, where you say, okay, let's take Sensex. So Sensex is market cap weighted. So all 30 stocks, but you buy equal proportion of all. Or on Nifty, you buy equal proportion. That is equi-weighted version of Nifty, and that would be smart beta. Okay? Then there are all kinds of tilts on low price to book, on small size, on dividend yields, on everything you can think of, and low volatility. So the earth-shaking part, where the philosophy comes, is always we have been told high risk. The earth-shaking part is they discovered the low volatility effect, which means when the risk is low, the stocks which have low volatility, low beta, actually beat the market. Okay? So that's a low vol or minimum volatility smart beta. So that is completely now changed. I mean, now do you believe high risk, high return? Otherwise, what is risk? Probably the definition of risk is wrong. So anyway, so this is the trend. There is a example of S&P equal weighted. There are numerous examples. There are hundreds of ETFs running on smart beta now. Currently, more than $500 billion is being already run on smart beta, which is growing at 60%. So you're looking at a very, very substantial $6 trillion out of total money in mutual funds is about $25 trillion. Okay, so out of that 6 trillion is going to be smart beta next few years. It's a very significant trend. And here I have shown you the innovation adoption life cycle. And usually you will see that the first innovators are, of course, the financial analysts, the technicians, and the academicians and researchers. And then they're followed by the early adopters, which are these mega funds, these nearly $1 trillion funds, who want to get a little bit of extra on their money or reduce the risk a little bit. Okay? It's very, very important, and they can easily finance this. So they've been working on this for more than 10 years now, and majority of the large funds have already adopted. They've done detailed studies on smart beta, and it's adopted. It's reached, probably in our estimate, it's at early majority stage, because we can see trends like Goldman picking up a company which is an expert in smart beta. So they just bought it out recently, and people like Goldman jump in exactly when the trend is starting to take off. Okay? So there are many such things, other transactions which have been happening. Towards the end of the early majority is when the family offices typically come in, when it's reasonably well established by the pension funds, and there are proven track records. Okay? So now it's very close to that point of time. The larger family offices in the developed markets are already adopting most of it. And there are numerous studies from pension consultants like Towers Watson's and MSCI, S&P, FTSE, you name it, all of them have smart beta strategies. We also have a smart beta strategy. Okay? So I've taken a US example because that's supposed to be the most efficient market, most difficult to beat, most analyzed. And you can see that the average mutual fund return of US large cap mutual funds is about 6.4. S&P itself gave about 9.2. Top quartile mutual fund is 9.3. So not very different from S&P index returns. The average smart beta return, and here we've taken all the established MSCI, FTSE, all of the smart betas, and the average of all of them is about 9.7. So it beats the top